There was a time when building wealth didn't feel loud. No notifications, no side hustles screaming for attention, no endless advice telling people they were one shortcut away from becoming rich. 50 years ago, most people followed a set of quiet financial rules, not because they were trying to beat the system, but because the system rewarded patience, restraint, and consistency. Wealth wasn't something you chased, it was something you slowly constructed. Back then, money was treated like a tool, not a personality. People didn't identify themselves by their income or their lifestyle. They identified by stability. A steady job mattered more than a flashy one. A predictable paycheck mattered more than upside potential. And the first rule almost everyone followed was simple: spend less than you earn, no matter how much you earn. This wasn't a budgeting hack, it was a mindset. Expenses were anchored to necessity, not desire. If income went up, spending didn't automatically follow. Raises didn't mean upgrades. Bonuses didn't mean splurges. They meant margin, and margin was safety. That gap between what you earned and what you spent wasn't wasted. It was the foundation of everything else. Debt was treated with caution, sometimes fear, not because debt was evil, but because it reduced freedom. Most families believed that owing money meant answering to someone else's clock. Monthly payments were viewed as a form of pressure, not convenience. So they avoided debt unless it served a very specific purpose: buying something that would last or something that would grow in value over time. Homes were purchased carefully. Cars were bought modestly, often used and driven for years. Financing something that lost value quickly was seen as unnecessary risk. Saving came before comfort, not after, before. A portion of every paycheck was set aside automatically, even when money felt tight. Emergency funds weren't trendy, they were survival. Cash in the bank meant you could say no. It meant you could absorb a surprise without panic. It meant you didn't have to turn a temporary problem into a long-term obligation. Investing wasn't exciting, and that was the point. Most people didn't trade, they didn't speculate. They invested in broad, boring vehicles and left them alone. Time did the heavy lifting. Compounding wasn't something people talked about, it was something they lived. Wealth grew quietly in the background, unnoticed, while life carried on. And maybe the most important rule of all was this: wealth was built slowly on purpose. There was no expectation that money should grow fast. Growth that came too quickly was treated with suspicion. Stability mattered more than speed. Because when progress is slow, mistakes are survivable. And when progress is steady, it becomes inevitable. Those rules weren't glamorous, they didn't make headlines, but they worked. And they still do, because the math hasn't changed, even if the noise has. Another rule people followed instinctively was keeping fixed costs low, and keeping them low for as long as possible. Housing, transportation, and basic living expenses were treated as anchors. Once set, they weren't constantly adjusted upward. Families didn't upgrade homes every few years just because income allowed it. They stayed put. They let inflation work in their favor. Over time, what once felt like a stretch became manageable, then comfortable, then easy. This created something modern advice rarely talks about: financial breathing room. When your biggest expenses don't rise as fast as your income, stress declines, even if nothing else changes. That breathing room made it easier to save, easier to invest, and easier to make calm decisions during uncertain times. People also understood the value of longevity, especially when it came to financial relationships. Jobs weren't jumped casually, not because people lacked ambition, but because stability compounded just like money. Staying with an employer often meant better benefits, pensions, and predictable raises. Skills deepened, reputation grew, income became reliable, and reliable income is one of the most underrated assets in wealth building. Insurance was another quiet cornerstone. Health, home, and life insurance weren't viewed as optional expenses. They were protection against catastrophe. People didn't insure because they expected something bad to happen. They insured because they knew if something did happen, it could erase decades of progress in a single moment. Risk was managed, not ignored. Lifestyle comparison existed, but it moved slower. Without constant exposure to curated lives, people compared themselves to neighbors, coworkers, and family, not strangers online. This reduced the pressure to perform financially. Spending was driven by needs and local norms, not global expectations. That alone kept many households from overextending themselves. There was also a strong respect for ownership. Owning something outright mattered. Being free of payments felt like progress. A paid-off home wasn't just a financial milestone, it was emotional security. It meant shelter was guaranteed. It meant retirement felt possible. It meant work became optional sooner than expected. And while incomes were often lower in raw numbers, the relationship with money was healthier. People expected financial life to have seasons. Some years were better than others. Setbacks weren't interpreted as failure, they were part of the process. Because the system wasn't built on constant optimization, it was built on endurance. What's striking is how little of this depended on perfect decisions. People made mistakes. They bought things they didn't need. They missed opportunities. But because their foundation was strong, low debt, steady saving, controlled expenses, those mistakes didn't destroy them. They were absorbed. The wealth that resulted from this approach wasn't loud. It didn't announce itself early, but over decades it became undeniable. Not because people chased money, but because they gave it time and structure to grow. Today, it can feel like those rules belong to another era. The world moves faster, costs are higher, advice is louder. But the underlying mechanics of wealth haven't changed. Money still responds to discipline. Risk still compounds in both directions, and stability is still more powerful than speed. What has changed is the temptation to skip the boring parts, to leverage early, to optimize constantly, to treat money like a game instead of a system. But the old rules were designed for resilience, not excitement. They were built to survive job loss, recessions, medical emergencies, and market crashes, and that's exactly why they still matter. The rule of spending less than you earn still creates margin. Margin still creates freedom. Avoiding unnecessary debt still reduces pressure. Saving before spending still builds security. Investing consistently still allows time to do the work you can't. Keeping fixed costs low still buys flexibility. Protecting against risk still preserves progress. Even patience itself is a financial strategy. When you're not in a rush, you don't force decisions. You don't overextend. You don't gamble stability for growth. You let opportunities come to you. And they do, quietly, over time. 50 years ago, people didn't talk about financial independence. They didn't label themselves investors. They didn't track net worth daily. But many of them reached a place where money stopped being the center of every decision. Work became a choice. Stress softened. Time expanded. And that outcome wasn't accidental. It was engineered through small, repeated behaviors that compounded. The most forgotten part of these wealth rules isn't the tactics, it's the attitude. Money was respected, not worshipped. Progress was measured in decades, not months. And success was defined by stability, not visibility. Those rules didn't disappear because they stopped working. They faded because they weren't exciting enough for a world addicted to speed. But if you strip away the noise, the fundamentals are still there, waiting, quiet, unchanged, reliable. Wealth doesn't need new rules, it needs remembered ones.